Anybody here from Jim View?
He's on, hopefully behind.
Okay, I was gonna say, he didn't say he wasn't coming. That's why I just want to make sure I didn't miss anything. Okay. Got it. Not a problem. Thank you.
I didn't know.
Yeah.
Very good. Thank you so much. Well, good morning. How are you? Good morning. I want to call this meeting of the Firefighters Pension Fund Board to order. First item on the agenda is investment report, and we will call investment manager is up to give us a report.
There's my pen. Thank you.
Good morning, everybody. Is that better? You hear me? Okay. I'm Paul Spiergus from WMS Partners. I will go through both the consolidated report for the firefighters pension and WMS's portion of that. Again, as I always state, we're the more conservative mandate in terms of asset allocation. And we're also responsible for making sure that the overall portfolio is compliant with the investment policy statement. So just starting off in terms of broad sort of market overview, the capital markets have been much stronger this year than I think a lot of people would have expected, primarily because the US economy has been a lot stronger than what most people would have expected. The past couple of years have been all about the Federal Reserve trying to bring inflation down after the pandemic, and have went through in 2022 with a really strong hiking cycle, increasing Fed funds rates at a pace and an amount, a magnitude that was much larger than what we'd seen in the past. Thus far, they've been they've accomplished quite a bit considering what's gone on in the economy of both getting inflation back down to target and keeping full employment. And so the markets have reacted positively, particularly the risk assets. One thing to note, though, is within risk assets, within US equities, which have been the best performing asset class for the past 15 years, the concentration within that part of the market has grown to a point that's much more than we've ever seen. And what I mean by that is essentially US equities have been driven primarily by 7 stocks. And it's all around the AI theme. And the last time we saw anything like this, was during the tech bubble in the late 1990s. Before that, it was the Nifty 50 stocks in the 1970s. Those 7 stocks represent over 35% of the S&P 500. The other 493 represent the rest. And it's an enthusiasm that kind of works until it doesn't. And so within our portfolio at WMS, we have focused more on owning more value-oriented factors, owning more of the average stock for the going forward period, because, owning those 7 stocks anywhere in the proportion in which the market does, in our view, is risky. So diversification, as always, is key. So with that as sort of the jumping off point, if you'll flip to the first section and page number 2 under that first section, this is the combined portfolio as of 9/30. And the total market value is about $50,316,000. The policy for the overall portfolio is to target roughly about 65% in equities and 35% in fixed income, with some flexibility around both. We are pretty much right on target. The overall allocation is about 64% in equities, and about 36% in fixed assets. The performance has been strong, both absolutely and relatively. Again, the capital markets have been extremely strong for these past 2 years. Year to date, so the first 9 months of this calendar year, the overall portfolio is up about 12.8%, trailing 12 months, 26.7%, 3 years annualized, 6.1% per year, and then 5 years trailing, 9.6% per year. If you'll flip to the next tab, this is the WMS portfolio, again, the more conservative of the two. We have about 45% in equity assets and 55% in fixed income. And what I will mention, again, I talked about how we're positioned on the equity side of things. On the fixed income side of things, for the past, up until this past year, for the past decade, I will say, we have been very, very short in terms of our duration within fixed income because of interest rates being held, you know, in our view, artificially low. With the Fed and their hiking and the terrible year of 2022 for bonds, which was the worst year ever for fixed income, that was a very good thing because we were able to hold off any significant losses. The Barclays Aggregate Bond Index, Bloomberg Aggregate Bond Index, was down almost 14% in that calendar year. Since then, though, we have extended our duration slightly. So whereas we had been less than 2 years, we're now between 3 and 4 years duration, and it has benefited the portfolio on the fixed income side of things. Year to date, the portfolio, the WMS portfolio, is up about 10%, trailing 12 months, 17.2%, 3 years, 3.5 per year, and that's in a period of time when the Bloomberg Aggregate Bond Index is actually down 2% a year, and trailing 5 years, 7.4% per year. Any questions or thoughts or concerns?
Just a question, not a concern. So I see
Or plaudits, I'll take those too.
in the well, my overall view is you're capturing what the market is allowing you to capture in this asset allocation, which is what you're paid to do. My question is your cash management philosophy right now. I see in the overall it's 4.5%, it's 6.3 in the firefighters' pension. Could you just give us a little bit of depth around that?
Yeah, sure. So as I mentioned, we've been trying to keep our duration short. And what ended up happening was when the Fed started increasing interest rates from 0 to over 5%, we started to think about money market as a strategic asset allocation part of the portfolio. So to be able to get over 5%, a 5.2% yield with virtually no risk whatsoever, we increased that holding. When we started to extend the duration, as I said earlier this year, we've been kind of whittling down the money market because obviously as the Fed reduces rates, so too will that money market rate eventually.
Is your outlook that the Fed will continue to cut?
It is. Not as aggressively, though, as I think the market thinks. So I think our view is that inflation will, well, and the elephant that's not quite in the room is the fact that we have an election in a couple of days. I don't know if everybody's heard about that or not. It's in all the papers. And that, the outcome of that will obviously affect all of this. We are of the opinion that inflation will stay stickier, certainly not where it was in October of 22, but stickier than what the market thinks. The market has been very apt to assume the Fed was going to be cutting rates faster than what they have so far and what we think they will next year. So they did 50 basis points at the last meeting. They meet next week. We may not even know who won the election by the time they meet. But Fed funds futures suggest that there will be 2 more cuts this year. The question is the magnitude of those cuts, be it another 50 or 25 at a point, or at a meeting. And then the expectation is at least another 100 basis points next year.
So what are your thoughts?
Yeah, yes, sir. I think inflation, so we've had this period of time from the great financial crisis through 2021 where there virtually was no inflation, right? And interest rates were at zero. We were more worried about deflation than we were worried about inflation. A lot of folks have sort of thought, have come to the frame of mind that that's the normal. That's not the normal. The normal is having some inflation, having interest rates that incent people to save and invest. So yes, I think the likelihood is more near the target of around 3% for CPI, headline CPI going forward.
Any other questions?
Great, thank you.
Good morning. Mike Glacken, President of CBIZ INR. As Paul said, we manage the second half of the fire pension assets. Our charge is a more aggressive allocation strategy. So our charge was roughly 75% equities, 25% fixed income. We also, at the end of the year, we combine the two assets and report back to Joe Duda. We're going to open up the right-hand side of the presentation is the performance report, and we're going to go to page 12, please. The other charge that we have is to help comply with GASB 67 and 68, where we squish the two plans together. We do the capital market assumptions, and we compare what we expect to get in a return from the entire pension plan to what you're using in the assumed interest rate. So that's one of the most important things as a committee that we cover. I'm going to go over that in a little bit more detail in the end. So first, I'm going to go over the performance report and also answer some of the same questions. So far, year to date on our position, again, we're given the more aggressive charge. We're up 14.38% year to date. The bond market is roughly up 4.25%. Stock market up roughly 18.64%. We use an all market indexed approach. So if they were to ask you what you own on the equity side, you own everything across the globe. On the bond side, you own over 17,000 bond positions. We also did the same thing, recognizing the Fed would be raising interest rates. We drastically lowered the duration of the bond portfolio, although that's only roughly 25% of our allocation. So we've had significant overperformance compared to the ag over the last few years because as interest rates rose, the bond portfolio didn't get hit as hard. On the equity side, what's tend to lead to higher than benchmark performance, even net fees over the long run, has been a few things. First being we rebalance on a regular basis. What that means is as assets run, we'll sell the assets high and buy other assets low. So over the last 2 years, what's happened is growth, basically 7 or 8 stocks have ran dramatically, right? So what we keep doing is selling them high growth and buying value low. The reverse happened in 2022. Value was high, growth was low. So we sold value and bought growth. So just to teach a few things, in the first half of the year, growth was still winning. So what we did is we sold growth and bought value, small cap stocks, mid cap stocks, and bonds cheap, right? And then what's happened since that second quarter is small company, medium-sized company stocks and bonds have outperformed growth. what's happened over the long run is that buying on sale has led to better than benchmark performance over the long run. Over the short run, what can happen is it can be a short-term drag on performance. And what I always say, and what I've been saying to you folks for over a decade is eventually we're going to look smart. I just can't tell you when. What's happened over the short run is with the volatility, we already look smart this year already because of that turnaround. And as Paul said, we don't expect growth to continue to lead over the next 2, 3, 4, and 5 years. So what's happened over the long run is if you look since inception on the very right-hand side, your total performance was roughly 8.52% on our charge, and the blended benchmark's around 8.13%. So you've had almost 40 basis points of overperformance, mainly coming from two different things: rebalancing. So we take human nature out of it, right? We're always going to buy on sale. And also we have had some strategic decisions along the way that have helped. And some of those this year, we have a much lower allocation to international. If you look at the stock market and you say how much is international versus how much is U.S., it's roughly 50-50. We have a much lower allocation to international equities, and we've had that for over a decade. So that's led to better than benchmark performance and the rebalancing. To bring up what we see in the future, given next week is the election, our clients have always benefited from geopolitical events along the way because we take human nature out of it. Whatever happens and whoever's elected, eventually the plan will benefit from it because we would rebalance. And the greatest example I can give you where we really didn't have a rebalancing opportunity, but we were ready to do it, was the last time Trump was elected. In pre-market, the market was down 5%, and the market was really in panic. It shut down. It hit the trigger. It was down 5%. Market shut down. And then we would have automatically rebalanced and went in and bought the stock market at a 5% discount, over 1,000 points. What happened, though, is by the time everybody came in, right, before the market opened, the market turned around and went back up and actually finished positive in that first day. But what to teach you, what would have happened had it stayed down 5% is we would have bought equities at a 5% discount, and it would have been a great buying opportunity. The biggest buying opportunity we've had in my 33-year career was the pandemic. On April 8th, we had one of our first Zoom meetings, Tommy, you can remember, and Pete. It was holding the phone up by their head and stuff. And this was really, I think, our first Zoom meeting, right? So I'm coming in and saying, David was on that call, and I'm saying, some of you were new to the board, and I'm saying, by the way, we're going to go in and buy the stock market at a 30% discount right now, April 8th. The other thing we're going to do is we're going to lean towards high yield, because when you see an abnormal correction, high yield bonds normally come out of a correction even faster than the stock market. So on April 8th, we went in and rebalanced. We bought the market at sometimes a little bit of luck is good too, at the best time to buy the market. And then the next day, Mnuchin came out and said, to prop up the bond market, I'm going to use a high yield bond ETF. The same exact ETF that we purchased, right? So there's some strategic decisions, but we're really taking human nature out of it. And we're doing the opposite of what your retail investor does. So the coolest thing that we've done here together when we first started is together as a team, along with the actuary, is we lowered your assumed interest rate. For the Township of Upper Darby to be at 6.75% on the Upper Darby Fire pension, we do over 100 municipal pension plans. You're one of the few, a handful, maybe 5, that the assumed interest rate matches the Gatsby 67 and 68 report that I give to him. So just to keep this simple, 65%, 35% stocks, 6.75% assumed interest rate. Guess what my capital market assumptions were last year? Almost 6.75 on the nose, right? So the cool thing about that is when he does, we provide him with the information. So I squish the two managers together. We give the addendum. He comes back with GASB 67 and 68. If the township goes out, for loan, for assets, the first thing they do is look at your pension obligation and what you expect to get, and they look at your GASB 67 and 68. And what we're most proud of in this township is they match. And the coolest decision we're going to have to make coming up, when I do that for Joe in right after January, I can do the numbers like January 1st, well, 2nd after the holiday. I'll forward them to Joe. We're going to have some cool decisions to make over the next year because we squish 2023 and 2024 performance together. Now, the outlier is it's a seesaw. You have cost of benefits on the right, performance on the left. You get it. So what happens is we take a look at that, and then we take a look at the funding level. You've had double-digit returns for 2 years in a row. You're using 6.75, right? Your total 6.75 multiplied by 2, and then compare that to double-digit investment returns over the last 2 years. So we're going to have some really cool decisions as a team to make going forward. So normally we'll meet with Joe. We talk to him regularly. When he was coming into this meeting, you were talking to Jennifer on the phone about refunding of contributions and that stuff. We'll come back to the township and say, hey, this is what it preliminary looks like before you lock in the valuation. You're going to have some cool stuff to talk about here. Looking forward as far as performance goes. So we're looking forward to what's coming in the future. What happens with the Middle East? What happens with elections? One of the other things, and I put a slide in here, but I'll just talk in the essence of time. I'll talk real fast through it. The market corrects every year on average by 14%, right? And the issue is most retail investors, that impacts them negatively because what you think is logical in the investment world, you're better off doing the opposite. So when the market corrects by 14% or more, you usually see about 25% of the assets in the market go to cash or go to bonds, right? We do the opposite. But you need to be ready and have the conviction as the committee that when it does correct, and we're only down about 8% in late summer, and we took advantage of that. That's also why we've snapped back so much. It's going to happen. And whether that happens in the election, whether that happens because there's a missile that goes across the border, as sad as this sounds, we're going to take advantage of it. And eventually we're all going to look smart if we have the guts and the fortitude to stay the course, right? We're going to win from that. That's actually where we've done the best. We take human nature out of it. It happens automatically. We can rebalance $2 billion in pension assets in seconds. So whatever's going to happen next Tuesday, something's going to benefit, something's going to fall. It doesn't matter who's elected. That's a fib too. On the economy, a stalemate is normally best. We'll take advantage either way. So with that, we're going to have some cool discussions. We might actually be able to slightly lower the risk level and still meet the assumed interest rate because as Paul said, and as David asked, and as you mentioned, Crandall, about interest rates, we expect interest rates to stay a little sticky. What that means is bonds look more attractive than they've been, although it's been pain to get there. So we should be able to take on less risk and get a higher return because of the bond side of it. So we'll talk together as a team about that in the real near future. How it works on the calendar is after January, we come in and show you where the numbers are. We preliminary send over, what things look like to Joe on that GASB 67 and 68. In the January or February meeting here, I go through what our capital market assumptions are, what we expect to get from 65-35 squished together. And then we make decisions from there the way the valuation looks, right? If you have a high funding level and a 6.75% assumed interest rate, and you can adjust the assumed interest rate maybe downward without putting a lot of pressure on the MMO, that's where the board, the township makes that decision, then maybe you lower the assumed interest rate. Maybe you keep the assumed interest rate where it is, right? MMO, you don't, minimum obligation is just that, it's a minimum. You could keep the assumed interest rate where it is and plan to put more money in to make the funding level look even better over time. That's what smart communities do. That's what we've done here from time to time. I know this is hard to get excited about, but next year is going to be early in next year is going to be some pretty cool meetings. So, thank you. We appreciate the opportunity. And any questions? Thank you.
I do have, thing it would be helpful if I could get like an electronic copy of like at least a week before the meeting so that I could look at. That'd be good. Thank you so much.
I imagine that's less important when there's really good news, but if it's medium to not so good news, then absolutely a little bit of advance notice would be welcome.
I 100% agree.
Thank you. All right, next item is authorization of payments. And I don't know what the process has been before, if you want to put out all of them, or if you want to, I can read them and we can do it all as a vote. Consent. Okay, sure. So we have a payment to Duda Actuarial Consulting, preparation and submission of GASB 67 in the amount of $1,900. Payment to Duda Actuarial Consulting for 2025 retainer for our pension plan in the amount of $7,425. Payment to Williams and Davidson for legal retainer in the amount of $47.60 for April 2024 through June 2024. Another payment to Williams and Davidson for legal retainer in the amount of $47.60 from July 1st to September 30th, 2024. Payment to BBD LLP for final billing for the audit of financial statements for the year ended December 31st, 2022, in the amount of $7,000. And payment to Kara Garvin for secretarial services for the third and fourth quarters of 2024, $350 per quarter for a total of $7,000. Can you get a motion on those payments? Motion made. Second, got a second. All approved? Any nays? Thank you, that's approved. Acknowledgements. And we have the retirement of John Miller, September 7th. Certainly mourn the passing of Frank Costa on May 25th. Passing of Robert Hartman on June 23rd. And refund of contributions for former Fire Chief Sawyer regarding his resignation May 5th, 2023. All right, that is seems to be the business we got here for an executive session. Do we want to deal with old and new business before we go into that? Okay, so is there any old business? Any new business? With that being said, we want to talk about dates for 2025.
Sure, you have anything?
I just have a couple of quick things. Well, we talked about the Sawyer refund, and I think Jen is going to be processing. Jen's going to be processing that payment, hopefully very soon. The interest is taxable. Okay, I don't have it here in front of me, but you know, I calculated the refund as of October 1st. Okay, so that will be forthcoming. The only other thing is I prepared and presented the MMO for 2025 for the township. And the MMO came out to be $2,439,988. Okay, and that was based off the 23 valuation. And I'm looking forward to doing the 25 valuation with the gains that Mike talked about. We should have a positive report. I'm thinking, I know we used smoothing in the last valuation here and everywhere else. I may go back to market value. That will give you a better result for the township because we have gains. I don't know if I want to smooth the gains. I mean, it's something that we'll talk about. But I would like to try, I think we have a meeting, well, I guess you're going to set the meeting dates. I would like to try to have some preliminary numbers. But then again, I guess it depends upon when you have the meeting dates. So that pretty much is it.
Joe, I had asked a year or two ago, this, and, we have a few people on the show, Ian and Mr. Freeman.
Right.
Could you just go over again the dates that you need certain items from the township to be?
Okay. The actual evaluation will take place on 1/1/25. And normally I would like to get that done in the summer because if it's a better result than the 23, which I think it will be, just based on what we're hearing here, that will give you a lower MMO, which is obviously better for the township. So I would like to probably try to get the data, the financial data, probably sometime in the spring if possible. As far as the salaries, the demographics, the retiree information I get from Mike Lacken's office, the salaries I get from Beverly. Okay, so I'm okay with that. It's just the financial data. So like if I can get that in the spring, sometime in the spring, then, I should have preliminary results for everybody, in the summer before the MMO takes place in September.
That was very, to verify something the last couple of years. Joe had asked over and over for certain things, knowing that he had to prepare reports and then he had to last minute, too late.
Yeah.
We almost missed the mark on the MMO preparation in 1 year where we would have lost out on some of the state.
Yeah.
So, obviously, I just want Joe to speak on that again, so that, things are stabilized here.
Yeah, I think that's the most important thing.
Running the board way before, things are on point. To get our light on.
Yeah, I don't know when the township has the auditor, the preliminary visit come in and, is that usually in the spring or?
That's what my normal is.
Okay. Okay, but if you can tell them if we can
Yeah.
get a draft statement of assets with the changes in assets for 2024, that would be great.
Okay.
Even if it's in draft form, I could use it and, prepare the evaluation results and, what your MMO might look like for 26.
All right.
That would be great.
Okay, I'll get you, Diane, and we'll talk about that.
Okay. Yep, thank you.
And I had just, not a question on the payment, but the TBD, is that in the township, that we originally sponsored the region light book, and then for the board, it got changed to mailing at some point, and now,
This is for your audit, right?
It is for our
Yeah.
pension.
that was just, that was discussed, and it was just always, this is for your use.
Okay.
I think it's where some of the issues.
Yeah.
Before, because Diane came in, at first, she's calling Joe for stuff, and she, well, I've been asking for this, and I can't get it because of
Yeah, she was asking me for my gas.
some communication issues, nothing, not pointing the finger at anybody, I just want to make sure,
Well, I will tell you, my experience is that the boards choose their auditors. And the township works with whoever the board chooses as the auditors. The township doesn't choose the auditors for the board.
Well, that's what's cheap, but I'm content with who you're comfortable with.
I'm not comfortable with anybody as an auditor now, because I don't know them. My presumption was that was an auditor that the board had chosen.
I don't have a preference over
Okay.
one, I'm not.
Okay.
I mean, Dave would probably be able to speak on that more than I would.
Well, I mean, I'll meet with them. We can meet with them and talk to them, and if they're fine, they're fine. I don't have I just wanted good auditors who are.
I think the changes that
Yeah.
Tom said was what created the confusion.
Okay.
You know, because it interrupted the process. at some
Absolutely.
point.
Understood. Okay. Thank you for bringing that to my attention. I appreciate it. All right. All righty. That seemed to be the last item of business. If there was nothing else,
We
no
have the
legal?
dates.
Oh, yes. I had my calendar up.
All right. So let me get something else in terms of our meeting frequency. What is our meeting frequency?
Once a year,
Okay. And
February and October.
And honestly, I'd love to have, I know we're getting ready to go into executive session to have a discussion. Honestly, I'd love to have more than 2 trustee meetings a year. I think this is as important enough that it should be at least quarterly, a quarterly meeting of the trustees. The market is not a 2 times a year market. It's at least a quarterly discussion. So that would be my recommendation, that we consider going to quarterly meetings instead of 2 times a year.
Do you have any input on certain dates that?
Just after I mean, we could meet anytime after the quarter. I mean, so that we
Yeah.
have
Right.
With a little bit of time.
Right,
Yeah.
right. I think if we're interested in doing it, what we can do, we'll talk it out, propose some dates, share them with you, and then we'll come up with something if everybody's good with that. Okay, very good. And so rather than do it right now, we will work it out, and then we'll announce and publicize what the meeting dates will be. All right? All right, thank you.
If it makes sense to the board, you might want to go ahead and schedule, while everybody's here, your February meeting date, because I imagine you're still going to want to meet in February after the year end.
Yeah.
And then in terms of future dates, we can do that after executive session.
Yeah, it's still
Thank you.
one up with-
Yeah, thank you. That's good. February.
Start to throw a wrench into the meeting. I will be out, it's the last week of February, 24th.
Okay.
Not that we have to follow it, but typically we would do the third Thursday.
Third Thursday?
We're gonna announce it now.
Again,
Yeah.
see what everybody's
I'm gonna
schedule.
use the bathroom.
Yeah, if we could, I have a conflict that day. If we could do look at the 13th,
13th?
Thursday, the 13th.
Yeah, I'm good on the 13th, Thursday the 13th.
You all right with, go?
Yeah, I'm good.
Oh, so Zoom, yeah.
So we'll
that's fine.
set that meeting for February 13th,
13th.
same time, 10 o'clock. That's good. And there you go. And then we'll get the other meeting scheduled after that. Thank you, everybody. So next meeting will be Thursday, February 13th at 10 o'clock, same place. All right, excellent. With that, I'll take a motion for adjournment of the regular meeting to go into executive session. Got a second?